Good morning, everyone. What I'd like to discuss today are the various considerations with respect to reversionary or non-reversionary pensions. A decision as to whether to commence a pension with a reversionary nomination is not always straightforward. In the first instance, the question to be asked and answered is whether there exists a person that would meet the definition of a reversionary pensioner. In the main, this is likely to be the individual spouse, but not an adult child, for example. The decision to commence a pension with a reversionary nomination should always be considered on a case-by-case basis, with an understanding as to whether the various implications of both reversionary pensions and non-reversionary pensions. There are a number of material benefits associated with reversionary pensions, such as favourable treatment of insurance benefits, estate security, and the capacity to maintain assets within the SMSF. If insurance proceeds from the deceased member's life insurance policy are paid to the reversionary beneficiary, then the proceeds also retain the tax-free and taxable components of the reversionary pension. The components are not recalculated despite the insurance proceeds having a taxable component. This can have a highly significant impact on the tax structuring. However, of course, if the pension is non-reversionary, then the insurance proceeds are added to the taxable component of the new pension. This may make a significant difference to the amount of tax payable by the deceased's beneficiary if they're under the age of 60. From the perspective of managing the security of the estate, a reversionary pension puts the trustee in a position in which the trustee is not required to make a determination as to who should receive the deceased's superannuation, as the pension will revert to the nominated beneficiary. This assumes, of course, that the nominated beneficiary continues to be a valid beneficiary. Importantly, also, as the reversionary pension automatically reverts to the nominated beneficiary, there is no need to sell assets to pay out a lump sum death benefit. The queries then get a little more complicated. In the event that the original pensioner dies, a reversionary pension could continue to be paid automatically, whereas a non-reversionary pension would cease on the original pensioner's death. Given the introduction of the transfer balance account and the transfer balance cap on 1 July 2017, we now need to deal with a number of issues as to when a pension is paid to the surviving beneficiary and under what circumstances. In the first instance, a receiving spouse owns the balance of the pension immediately upon the decease of the original pensioner and will therefore count towards the surviving pensioner's total superannuation balance. In the event that a non-reversionary pension has ceased at the death of the original pensioner, until such time as the trustee resolves to pay a new pension to the surviving pensioner does not own the balance, and it will not count towards their total superannuation balance until, as I say, such time as the new pensioner commences. Of course, if the death benefit is paid out as a lump sum, it will never count towards the recipient's total superannuation balance. Given the introduction of the transfer balance account, total superannuation balance and transfer balance cap regime in 2017, the issues associated with the transfer balance cap and transfer balance account are a little more complex. We are often asked as to when a transfer balance account is created for the receiving spouse in the case of a reversionary pension. In this case, if the recipient doesn't already have a transfer balance account, they may not have had previously any retirement phase pensions, a transfer balance account is created immediately on the death of the original pensioner. In the event of a recipient elect to commence a death benefit pension, the transfer balance account is created only when they start receiving the new pension. Notwithstanding that the transfer balance account may commence for the receiving spouse on the death of the original pensioner, the amount counted towards the transfer balance cap is the value of the pension interest on the date of death. Thus, in a situation in which insurance proceeds are added to the benefit after death, there can be a considerable difference to the amount that could be counted against the recipient's transfer balance cap. In the event that the reversionary pension receives an amount of life insurance after the death of the original pensioner, the life insurance component is not included in the amount that is recorded for the transfer balance cap, as it is the reversionary pension's value at the date of death that is counted. If the pension did not automatically revert and insurance proceeds were received, there may be some further restructuring to do if the additional insurance proceeds cause a technical issue with the counting towards the death benefit pensioners' transfer balance gap. As we referred to earlier in this presentation, the decision as to whether a pension is commenced with the reversionary nomination or not is always not straightforward and needs to be examined on a case-by-case basis. Thanks for your time, and I hope you enjoy the new background, and we'll catch you next month.